February walks into the stock market every year like it owns the place, and then, almost on cue, it trips over its own shoes. We're talking about the 1 month on the calendar that financial Twitter quietly dreads but rarely wants to admit out loud. And look, it's not like the market crashes every February in some dramatic Hollywood-style collapse. It's more like the air just slowly leaks out of the tire. Historically, February ranks among the weakest months for equity performance, and that pattern has shown up with enough consistency that even the most hardened skeptics have started raising an eyebrow. So why does this happen? And why does almost nobody talk about it the way they should? The answer starts with something called the January effect, which is essentially the market's version of a New Year's resolution. Investors pile into stocks in January with all the enthusiasm of someone joining a gym on the 1st. And by February, just like that gym membership, the momentum quietly fades. Think of it like a rubber band that gets stretched really far in one direction. January pulls it tight with optimism, and February is when it snaps back. The technical term for this is mean reversion, but the human translation is simply what goes up fast on vibes alone tends to cool off just as fast. There's also a tax-related dynamic quietly working in the background that most retail investors completely overlook. Institutional money managers, the big funds moving billions, often rebalance their portfolios in late January and early February, which creates selling pressure that ordinary investors feel but can't quite explain. Add to that the fact that February is the shortest month of the year, and you've got fewer trading days to recover from any early month weakness. It's like running a race where someone quietly shortened the track but forgot to tell you the finish line moved. Now, here's where it gets psychologically interesting, because the data doesn't tell the whole story on its own. Studies going back to the 1970s show that February has the second lowest average return of any month, trailing only September, which has its own haunted reputation on Wall Street. But here's the irony. Every single year, a fresh wave of investors convinced that this time is different charges into the market in late January, fully expecting the good times to keep rolling. And then February arrives like a polite but firm bouncer saying, "Not tonight, friend." The lesson history keeps trying to teach us, and we keep forgetting, is that seasonal patterns aren't destiny, they're tendencies. And tendencies deserve respect without worship. You don't bet the house on a seasonal pattern, but you also don't ignore decades of behavioral data just because you feel good about the market right now. The practical move here isn't panic, it's preparation and position sizing. If you're overexposed to high beta, momentum-driven stocks heading into February, history is quietly suggesting you might want to trim, hedge, or at the very least, not be adding aggressively in the first week of the month. There's a beautiful irony in the fact that the market's weakest months are often its most teachable ones. February doesn't break portfolios overconfidence and poor sizing break portfolios. And February just happens to be the month that stress tests both. The real edge in investing isn't predicting what the market will do. It's building a process so disciplined that the outcome almost stops mattering. Whether February is flat, up, or down, the investor who sized correctly, stayed unemotional, and trusted their system walks away, learning something valuable either way. At the end of the day, markets are just mirrors reflecting human behavior at scale. And human behavior is wonderfully, frustratingly predictable in cycles. February isn't a villain. It's a reminder that discipline, patience, and humility are the actual portfolio managers running the show. So go into every February with open eyes, a clear process, and the quiet confidence of someone who's done their homework and isn't surprised by a little turbulence. And if you want to take that same disciplined mindset and apply it to building real wealth through real estate, contracting, or finding the right lenders, check out our links in the description below. We can help you get started.